Howard Marks has often said, "You can't do the same thing as everyone else and expect to outperform." This simple yet profound statement lies at the heart of contrarian investing, the art of going against the crowd. But what does it truly mean to think differently in the financial markets? And when is contrarian thinking the right path, rather than a reckless gamble? In this part, we dive deep into the philosophy, psychology, and practice of going against the herd, exploring why Marx believes independent thinking is not just a preference but a necessity for long-term success. In every market cycle, there's a narrative. In boom times, it's optimism, growth, and this time it's different. In bear markets, it's fear, pessimism, and this will never recover. The crowd follows these emotions, swinging like a pendulum between greed and panic. But Howard Marks teaches us that understanding this crowd psychology and knowing when to step away from it is one of the most powerful edges an investor can have. Contrarian thinking doesn't mean reflexively doing the opposite of everyone else. It means thinking independently. It means questioning assumptions, analyzing data critically, and forming opinions based on reason rather than emotion. Marx calls it second-level thinking. First-level thinkers see that a company's stock is rising and assume it's a good buy. Second-level thinkers ask, why is it rising? Is it already overpriced? What does the market believe, and might the market be wrong? This mindset allows contrarians to recognize opportunities that others overlook. Consider this: when everyone believes the market can only go up, risk is actually at its highest. Conversely, when fear dominates and prices collapse, risk is often lowest. Yet the majority acts in reverse. They buy during euphoria and sell during panic. Contrarians, by contrast, prepare for those emotional extremes. They know that market sentiment always swings too far in both directions. The challenge is not spotting this pattern, it's having the courage to act on it. Marx often compares contrarian investing to standing alone in a storm. It's uncomfortable, uncertain, and emotionally taxing. But it's precisely in those moments of widespread fear or greed that the seeds of future profits are planted. Being too far ahead of your time is indistinguishable from being wrong, Marx once joked. Contrarians often appear foolish until they're proven right years later. The question is, can you endure that period of being misunderstood? Let's look at history for examples. In the late 1990s, during the dot-com bubble, technology stocks skyrocketed. Anyone who questioned their valuations was dismissed as out of touch. Howard Marks, however, warned that excessive optimism was blinding investors. When the bubble burst, those who maintained skepticism were among the few standing. Similarly, in 2008, when panic consumed the markets, Marks and a few others saw opportunity. Oaktree Capital, his firm, made significant investments in distressed debt at deep discounts. While others ran from risk, he recognized that the market had overreacted. Within years, those investments paid off massively. What separates Marx from others isn't just analytical skill, it's temperament. He understands that the crowd is not stupid, it's human. People crave safety in numbers. But in markets, safety in numbers is often an illusion. True safety lies in price and value, not popularity. So, how can you train yourself to think independently? Start by embracing discomfort. When your opinion differs from the majority, that's not necessarily a sign you're wrong, it's a sign you're thinking for yourself. Next, focus on data, not narratives. Stories move markets in the short term, but fundamentals determine outcomes in the long run. And finally, remember that patience is a contrarian's greatest ally. It may take months or years for your view to be validated, but truth and value eventually converge. Marx encourages investors to ask, what does the market believe, and why might it be wrong? This question alone can transform your decision-making. It forces you to think deeper than the headlines, beyond emotion, and into logic. But thinking differently is only half the battle. Acting differently when everyone around you disagrees is the true test of discipline. Are you prepared to buy when others panic? To sell when optimism peaks? To question your own biases when the crowd reinforces them? Contrarian investing isn't for everyone. It demands humility, courage, and conviction. Yet for those who can master it, the rewards are not just financial, they're intellectual. You're no longer reacting to the market's mood swings, you're observing them, understanding them, and positioning yourself accordingly. In the next part, we'll dive deeper into the psychological traps that prevent investors from thinking independently. Why do so many intelligent people fall victim to herd behavior? And how can you protect yourself from being swept away by collective emotion? The answers might change how you see not just the market, but human nature itself. Why do so many investors, intelligent, educated, rational individuals, fall into the trap of following the crowd? To understand contrarian investing, we must first understand the human mind. Howard Marks frequently reminds us that the greatest enemy of the investor is not the market, but themselves. Our brains are wired for survival, not for rational investing. When we see a crowd running in one direction, our instinct is to follow. In the wild, that behavior kept us alive. In the stock market, it can destroy wealth. The psychological foundation of contrarian thinking lies in recognizing and resisting these instincts. When prices soar, our brains release dopamine. We feel validation, confidence, even euphoria. We convince ourselves that everyone can't be wrong. When markets crash, fear grips us, and our survival response tells us to flee. Yet, as Marx says, the biggest investing errors come not from factors that are informational or analytical, but from psychological or emotional influences. So, how can we identify the emotional waves that control the crowd? One of the most common traps is confirmation bias, the tendency to seek information that supports what we already believe. During a bull market, optimistic news dominates because that's what people want to hear. Investors follow this wave, ignoring warning signs, until reality catches up. Contrarian thinkers deliberately expose themselves to opposing views. They read reports that challenge their assumptions, listen to pessimists during euphoric times, and seek data rather than comfort. Another powerful force is social proof. Humans crave belonging. When everyone around us is investing in a hot stock, it feels almost irresponsible not to join. Marx notes that in such moments, fear of missing out replaces fear of losing money. This inversion of fear is deadly. Contrarian investors, by contrast, keep their emotions anchored. They understand that the greatest opportunities often arise when acting alone. The irony of markets is that consensus views, by definition, are already priced in. The only way to achieve superior returns is to hold a non-consensus view and be right. Marx emphasizes that both elements are essential. Being different alone isn't enough, you must also be correct. But how can one tell the difference between independent thinking and arrogance? The line is thin. True contrarians are humble. They constantly question their assumptions. They know that being different for its own sake is not wisdom, it's recklessness. Real contrarianism is grounded in analysis, valuation, and patience, not defiance. The challenge lies in timing. Acting contrary to the market doesn't guarantee immediate results. As Marx says, being early is the same as being wrong for a while. Imagine you identify a bubble and sell your stocks. The market might continue to rise for months, even years. You'll look wrong, face criticism, and doubt your conviction. But if your reasoning is sound, time eventually proves you right. This requires immense psychological strength. Marx has often shared that the best investors are those who can endure being uncomfortable. They accept temporary underperformance because they know true value takes time to reveal itself. Let's take an example from Marx's career. During the early 2000s, when high-yield bonds were dismissed as too risky, Oaktree Capital quietly built positions. Most investors avoided them, fearing defaults. But Marx's analysis revealed that the market had overestimated risk. When conditions stabilized, those bonds surged in value. It wasn't luck, it was disciplined contrarian analysis combined with courage. Another key insight from Marx is that contrarian opportunities are rarely obvious. When something looks cheap, there's usually a reason. You must determine whether the market's fear is justified or exaggerated. That's where deep research, skepticism, and judgment come in. Contrarian investing is not about optimism or pessimism, it's about realism. It's the ability to look at facts without emotion and to act based on evidence, not mood. Marx frames this through the concept of pendulum behavior. The market constantly swings between euphoria and depression, greed and fear, risk-taking and risk aversion. The contrarian's job is to recognize when the pendulum has swung too far. When optimism is universal, prices are inflated, and potential returns are low. When pessimism dominates, assets are undervalued, and opportunity emerges. The secret is to act at these extremes when it feels hardest to do so. It's a paradox. The best time to buy is when you least want to, and the best time to sell is when you feel unstoppable. Yet that's exactly what most fail to do. Marx often quotes Warren Buffett, "Be fearful when others are greedy and greedy when others are fearful." But he adds a vital nuance: knowing when the crowd is truly fearful or greedy requires deep observation, not slogans. Many claim to follow this advice, but few actually do. Why? Because standing apart requires conviction built on understanding. Without a strong foundation in analysis, contrarian moves become mere speculation. So, how can you build that foundation? Marx offers a roadmap. 1. Understand market psychology. Recognize that prices reflect emotions as much as fundamentals. 2. Focus on intrinsic value. Measure assets by what they're worth, not what they're trading for. 3. Track cycles. Know where we are in the market cycle: optimism or pessimism, expansion or contraction. 4. Be patient. Contrarian insights take time to mature. 5. Maintain humility. Always question your own conclusions. In essence, contrarian investing is about balancing confidence with caution, independence with discipline. It's not about opposing others, it's about thinking deeply enough to form your own truth. In the next part, we'll explore how Howard Marks translates these ideas into action. How contrarian thinking becomes a real investment strategy. How does one identify those rare moments when the crowd's perception diverges from reality? And how can you seize those moments without losing your nerve? These questions lead us to the essence of Marx's philosophy, that success in investing is not about predicting the future, but about understanding human behavior. Contrarian investing, as Howard Marks often reminds us, is not an act of rebellion, it's an act of discipline. To think differently from the crowd, one must first understand the crowd deeply. The market is a living organism composed of millions of human decisions, and those decisions are driven by fear, greed, hope, and regret. A true contrarian doesn't just oppose these forces blindly, they learn to interpret them, to sense when sentiment has reached an extreme. Marx argues that the most dangerous phrase in investing is, "This time it's different." Whenever investors convince themselves that the old rules no longer apply, the seeds of disaster are sown. Think of the dot-com bubble. The crowd believed technology had changed the fundamentals of valuation forever. Earnings no longer mattered, growth and vision did. Investors piled in, and prices reached absurd levels. A contrarian who questioned that narrative in 1999 would have faced ridicule, but by 2001, they would have been proven right. The same story repeated during the housing boom of the mid-2000s. The crowd believed that home prices could never fall nationwide. Marx and other value-oriented thinkers saw the illusion and stepped back. The subsequent crash was both inevitable and predictable to those who refused to be swept away by optimism. Contrarian thinking, then, is about pattern recognition. History doesn't repeat exactly, but it rhymes. Each cycle of greed and fear follows a similar emotional path. Marx teaches that markets oscillate not around fair value, but around the extremes of euphoria and despair. The intelligent investor learns to buy when despair creates undervaluation and to sell when euphoria inflates prices beyond reason. But how does one develop the courage to act in those moments? Marx offers a simple but profound answer: preparation. Before opportunities arise, the contrarian has already built mental and analytical frameworks. They know what a company is truly worth, what risk actually means, and what kind of market behavior signals excess. When panic hits, they don't react, they execute. This mindset is impossible to cultivate overnight. It requires years of studying cycles, mistakes, and human behavior. Marx compares it to building emotional muscle memory. The more you experience market swings, the better you recognize the patterns and manage your reactions. A key distinction in Marx's philosophy is between risk and volatility. The crowd often equates short-term price drops with danger. Contrarians see opportunity. To them, true risk is not price movement, it's the permanent loss of capital. A falling price may signal fear, not fundamental weakness. The contrarian's task is to determine which is which. Are investors fleeing for emotional reasons, or is there a real structural problem? Marx urges investors to ask hard questions. Is the market's pessimism justified? Has the price fallen below intrinsic value? Or is the crowd's optimism blinding it to danger? Each question cuts through noise and forces clarity. Contrarian investing also demands patience. Acting against the crowd often means being early. Marx tells us that good ideas don't immediately translate into good performance. There's a lag between insight and validation. Many investors can't tolerate that lag, they abandon their positions just before they pay off. The contrarian, however, understands that discomfort is part of the process. Being right eventually often feels like being wrong temporarily. Consider the example of Oaktree's behavior during the 2008 financial crisis. When markets collapsed and fear was universal, Oaktree bought distressed debt. These assets looked toxic to everyone else, but Marx's team recognized that their prices had fallen far below their actual value. Over the following years, as the market recovered, those positions generated enormous returns. This wasn't luck. It was the deliberate application of contrarian discipline, acting rationally when others acted emotionally. Marx often emphasizes that contrarianism isn't about always saying no when others say yes. Sometimes, the crowd is right. The goal is not to oppose for opposition's sake, but to identify when sentiment diverges from reality. It's about having the intellectual honesty to say, the market is correct here, and the courage to say, the market is wrong there. The hardest part of this mindset is emotional independence. When everyone else is celebrating gains or panicking over losses, it takes immense self-control to remain calm. Marx likens this to standing in the ocean while waves crash around you. The crowd moves with the tide, you must learn to stand still. It's not easy. The fear of missing out, the pain of short-term losses, and the desire for validation constantly pull at you. But those who can resist these pulls are rewarded with clarity. They see the market as it is, not as they wish it to be. Another insight from Marx is that contrarian opportunities often appear during periods of maximum uncertainty. When the future feels unclear, the crowd freezes or sells. Yet, that very uncertainty creates mispricing. Contrarians are willing to invest when visibility is low, provided they understand the underlying fundamentals. They know that certainty is expensive. By the time everyone feels safe again, the best opportunities are gone. Marx calls this the paradox of investing. The greatest bargains come when things look bleakest. The contrarian doesn't wait for reassurance, they act before it arrives. Still, contrarian investing requires humility. Not every bet against the crowd will succeed. Sometimes the crowd is right, and the contrarian is wrong. That's why risk control is central to Marx's philosophy. Contrarians don't wager recklessly, they position themselves so that if they're wrong, the damage is manageable. They diversify, they size positions carefully, and they remain flexible. As Marx writes, experience teaches that the best investors are those who balance arrogance and humility, enough arrogance to believe they can add value, and enough humility to recognize that the future is uncertain. Ultimately, contrarian thinking is a mindset, not a tactic. It's the discipline of questioning narratives, recognizing emotional extremes, and maintaining perspective amid chaos. It's a philosophy that extends beyond investing, it's a way of understanding how humans behave under pressure. To think contrarily is to think clearly. It's to refuse easy answers, to look beyond headlines, and to trust one's reasoning when the world panics. Howard Marks doesn't ask investors to be rebels. He asks them to be students of behavior, to know that the market's greatest illusions are born in the minds of its participants. The final lesson of contrarianism, as Marx teaches, is not merely about when to buy or sell, but about who you must become to do so successfully, a thinker capable of calm in the storm, skepticism in the frenzy, and conviction in the silence. Before we wrap up, remember this: the greatest investors aren't those who follow the crowd, but those who understand it and have the courage to think independently. If this video helped you see the markets from a new perspective, make sure to subscribe to the channel and turn on the notification bell so you won't miss the next deep dive into the minds of legendary investors. Share your thoughts below. What's the boldest contrarian decision you've ever made in investing? I'd love to hear your stories. Until next time, stay curious, stay rational, and invest wisely.